let's move on to our last segment, actually. And Greg, I'm interested to see what you got cooked up for us here today. You sent me a message, like you do each and every Thursday in the early morning. Tell me what stocks you're going to be approaching, what sector you're going to be approaching, and why. And you've decided to focus on the utility sector today for buy one, hold one, and dump one. And if you're out there watching our show, we have different segments each and every day on the Halftime Report, whether it's on Friday with Coach Frank's charts or Wednesday with Jedi Options with Tyler, which I enjoyed that one a lot yesterday, or Thursdays with Greg, who we call him the old money Holmes for a reason. He's got an older, mindset in terms of investing and, just that classic approach to dividends and value and all that kind of stuff. So we've got this segment we call buy one, hold one, and dump one, where Greg presents 3 different stock ideas, all within one basic theme or industry or sector. And then we got to choose which one we would buy, which one we would dump, and which one we would hold. Greg, you are up. What do you got?
Yeah, so if you could pull up XLU for me there, Ty. I chose this one. Matt kind of alluded to it at the start of the show there. This is the thing. We got a slow news day. And this is a slower sector. This is a slower, more of a longer term approach to investing. Utilities are never traditionally something that's going to blow your doors off from a price perspective, but they tend to have, and I say tend to because not always, but they tend to have just kind of a slow grind when it comes to making cash flow and capital gains for investors. And so I saw this nice little rounded bottom here, which is one of the things that I look for a lot. As you can see, utility is kind of taking it on the chin for a while there, held the support at the 200. Now it's making that rounding bottom, popping up above the 20 there as well. Obviously, we've got some overhead resistance at the 50. That's just the technical pattern it is. But when we start to focus on this, again, this is going back to my core as an investor / trader. I'm looking for that consistent income over and over, and this is the idea that I bring to you today. I just think the utility space, it's really not going to do anything crazy, but it does have some consistency, and you're going to see when we run the numbers this morning on the 3 companies that I chose. Consistency is definitely in its wheelhouse. So. Like I said, chose 3 dividend payers in the utility sector. First up, we've got LNT. Now, some of these you may have heard of before. Some of them may not. Not all of them are household names. I know maybe the next one you guys might recognize, but all of these companies, when you do a little bit of research, they can show you some pretty awesome things. So, what I like here is this looks very similar to the ETF there. Little rounding bottom. We're poised right at those moving averages there. Obviously, like to see that pop up above there. But really, this is again more about a cash flow trade. If we get some price appreciation, great. If we get a little bit of growth beyond that, that's good too. So, numbers wise for this one, we're looking at a $56 stock or approximately there. It's about 2.83% dividend. 17 years in a row of consecutive dividend increases. They started paying dividends in 1946. So it's got a long history of those dividends. Payout ratio is only 64%. So they got lots of room to continue to pay those increasing dividends. Their PEG ratio, their PE ratio right now is about 23. Then we get into the fundamentals of this particular stock. We got 17, almost 18 billion in assets versus 12 billion in liabilities. So solid that way. Got about 486 million in free cash flow, and they've had 4 years of consecutive growth in their net income. So that's a rising net income 4 years in a row. Sales numbers wise, you're looking at a 5.3% for this year and a projected 2.3% for next year. So growth numbers, as I said, not really going to blow your socks off, but still somewhat decent for this year as far as I'm concerned. So that's the first one. The second one is AEP. So this is one some people may have heard of. American Electric Power. So low retracement confirmed above the moving averages there. Just failed, I guess, at that 50 today. Just pulled back. When I looked at this morning, it was up above there. I think you've got some run here. Now, this is an $85 stock. If we get above that 50, you could be looking at the 90 at some point in the near future there as a level of resistance. Obviously, we've got earnings coming up on these things, so I will throw that caveat out there right now. It's not immediate, but it's coming up soon. So be aware of that. When you start looking at investing, the earnings become less of a concern, but still something you need to know about anyway. Okay. So numbers wise for this one, these are going to look a little different. Obviously, a higher dollar stock. The dividend on this is 3.5%, 3.46. It's a little bit higher dividend. 11 years of consecutive dividend increases. This is that longevity that I was talking about. Started paying dividends in 1909. So well over 100 years of dividend payments. Exactly the same payout ratio, 64%. So lots of room there. PE ratio of 19. So pretty low there, compared to the rest of the industry. Assets versus liabilities, you're about 80 billion versus 60 billion in liabilities. So you got 20 billion extra there in assets. Now this is kind of something interesting that you'll see with some of these utility companies. It has a negative free cash flow of 2.9 billion. Okay, so it's in the hole. 3 years of consecutive net income increases, and their sales growth numbers for this year, 9.2% this year and 4.1% next year. Okay. So the next one up is NEE, NextEra Energy. So a little different pattern. So we've had three kind of different patterns with these things here. This one here, kind of a cup and handle breakout, looking above, getting that above that 200 there. Again, earnings coming up. Again, there's room to run with these. The reason I looked at these is I think there's some value right now. The prices that these are at, they're not kicking at their highs there. They've had a bit of a beat down. They've got a reversal characteristics on this particular one here from a technical perspective. So that's something to think about as well. And again, technical pattern there, you've got a little mini cup and handle there as well. So NextEra looks like this, 2.1% dividend. 19 years of consecutive dividend increases. They've started paying consecutive dividends since 1990. So almost every year they've been in existence, they paid an increasing dividend. Their dividend payout ratio is up at 70%. Still a little bit of room, but not as much as the other two. Now their PE ratio is a 34, so quite a bit higher than the other two. Assets and liabilities, they look good. They got 127 billion assets versus 83 liabilities. Again, they have negative free cash flow. So again, just to be aware of that, negative 163 million in free cash flow, and they have 0 years of of increasing net income. Growth numbers wise, these guys are the best of the bunch. 10.9% this year and 9.2% projected next year. So those are the three candidates we have for this week.
All right. So there's a couple of things that we need to unpack here, as I'm looking through these stocks and thinking about it. I don't know if any of you really want to go first. I can go first, though. I've got a couple of thoughts here. Maddie, AEP, NEE, and LNT. Tyler, can you flash through the charts one more time? Let's talk a little bit about who these companies are. LNT, $14 billion market cap company. Obviously, it is a traditional utility selling coal, natural gas services throughout the Midwest in the U.S. AEP, though, is, a little bit of a different company here. They actually are really strictly electricity. They don't really have a natural gas kicker. It's your traditional utility. They sell electricity. They process coal to do it, a lot of hydro fuels, things like that. They are getting into things like solar. I'm looking at their prospectus, but it's not a big segment of the company. NextEra and NextEra, I guess you should say it, NEE, actually is getting more into some solar and wind and alternative energy fuels. It's why they rebranded the company. This company used to be by a different name, by the way, Greg. It was LP. It's been around forever. A lot of these companies have been around forever, by the way. In 1925, it was founded, but they're now moving more into solar, wind, as well as their traditional electric components, those kind of things. So the PE ratios and the sales numbers might represent a slightly different thing because they have different business segments. I wouldn't say models, they're utilities, right? But a little bit different business segments. Now, Tyler, can you run me through the detail of the data before we start making decisions, though, and kind of give me what your thoughts are just from what the data is being presented by Greg?
Yeah. All right. So LNT. So this is the cheapest stock. I'll highlight maybe what is, I think, unique about each column here. So $56.91, cheapest stock of the three. Dividend yield 2.83, right in the middle of the other two. Increased for 17 consecutive years. Started paying the dividend in 1946. Payout ratio 64%. PE ratio is right in the middle here. Sales growth 5% this year, 2% next year. Assets versus liabilities 17.7 billion versus 11.8 billion. 486 million in free cash flow, and increasing net income for the last 4 years. You got AEP, 85 bucks. This is the highest dividend yield of the three. Dividend increase for the last 11 years. Started paying dividends in 1909. Payout ratio the same as LNT. PE ratio the lowest of the bunch. And 9% sales growth this year, 4% sales growth next year. 80 billion in assets versus 60 billion in liabilities. Negative 2.9 mil or bill here.
Billion.
Greg? Billion in free cash flow. 3 years increasing net income. Finally, you got NextEra NEE, 75 bucks, 2.1% dividend yield, so the lowest dividend of the bunch. 19 years consecutive dividend increases. Started paying those in 1990. Payout ratio is the highest of the bunch at 70%. PE ratio also the highest of the bunch. 10% sales growth this year, 9% next year. 127 billion in assets versus 83 billion in liabilities. 163 million negative free cash flow.
Correct.
No years of net increasing net income.
Okay.
Consecutive years.
And the charts real quick, Ty, as well.
And all right, so you want 5 year or short term?
Yeah, I'm looking at weeklies on my side because these are utilities. I mean, the analysis probably has to start long term, right?
Yeah, for this type of investment. Yeah. So NextEra, you got a nice 5 year uptrend. The other thing, I don't know if you saw this, Tim. Nice little stock split last year.
I did not. No, oh, there it is. Yep, 4 to 1.
Not common to find a company that did a stock split in 2020. Right? Impressive. LNT, overall uptrend as well, and more volatility, and then AEP. Oh, been hanging last year here. So there's your 3 charts.
All right. If nobody else wants to go first, I'm going first. Good.
That's fine.
I'm going.
I got my numbers.
I got my answers. Go to the option chain real quick. My dump is easy for me, and I'll show you a couple reasons why. If I'm thinking about a utility dividend payer investment, that's going in my retirement account. That's a long-term play. Long-term plays, I also like the potential to write a cover call or two, even if it's a small return. With a dividend payer, I'm willing to accept a smaller return on a cover call if I'm going to play it that way because I am getting compensated through the dividend. That being said, there's one that stands out here from an option chain perspective to be thrown out for me, LNT. And I'm not buying a utility if I can't write a cover call at some point, theoretically, if I want to. Don't like the option chain on Alliant. I just don't. I'm looking at the volatility and it's low like utilities. I'm looking at the bid-ask spread on the options and they're really wide. Be very difficult for me to write cover calls, do any kind of management there. Now, AEP and NEE are not great, but they have 10-cent spreads instead of $1 spreads. Okay. So for me personally, and this is my choice to buy, dump, and hold on my side, options would matter here. And so LNT would be the automatic dump. Just simple. I'll make that part simple for me. Charts next, if we can. From a chart perspective, AEP is your traditional dividend payer. I'm looking at the fundamentals. They're fine. Their revenue is consistent, year over year over year. They do about $15 billion worth of revenue. They don't have any aggressive share buyback program. They're rewarding their investors through a nice 3.5% dividend. The cash flow and ratio, that didn't bother me at all. I don't care about that right now. I'm looking at a very neutral, very stable, long-term utility that could be written with a 1% cover call. AEP is the hold for me, which is going to, by deductive reasoning, give me NEE as the buy. Looking at just a quick glance at the chart, I can tell why their dividend's a little lower. They're compensating through growth. Looking at why their PE ratio is a little bit higher is because they're investing in new technology, new facilities. They're going into different segments in their business and not just staying that traditional utility. NextEra is the buy for me. LNT is the dump for the options, disqualification, and that leaves AEP as the hold for me.
Well done, Timmy. You, despite using different logic, have arrived at the same conclusion as me. And you saw, I didn't type nothing while Tim was doing that. I had written this beforehand. So great minds think alike. I had NEE as the buy because I like the higher growth potential. I love the fact that it had a stock split last year. I feel like that's a boss move in the middle of a pandemic. Even if they did announce it ahead of time, I think that's great. I like the growth potential. And to Tim's point, look, I mean, you're getting rewarded in growth, but nonetheless, it still has a market beating dividend. 2.1% is not bad at all. So for all those reasons, I think NEE is the easy buy here. I would also dump LNT and hold AEP. I think I like, I mean, look, I could come up with a couple different excuses here. AEP's got a lower PE ratio. How about that? Been around longer than LNT, so got a little more history. And it has the highest dividend yield, plus the kicker with the options. So I think in a side-by-side comparison, I'm with Tim. I like AEP, which means I'm dumping LNT.
I do think covered calls are very important in the utility conversation. These are utilities, and outside of the 2002 to 2007 market, this is an area of the market that fundamentally underperforms the stock market. And so cash flow, covered calls, dividends are very important for this space. I'm sitting there listening to you and Tyler talk about NEE and the growth potentials. And I'm like, maybe sometimes just stay in your lane and perfect your utility side of your business. I don't know if we should attach growth to everything. And don't get me wrong, I totally understand people wanting to evolve their companies and so on and so forth. But utility companies should focus on utilities and perfecting the utility side of their business. We have some problems in America with utility companies. Perfect that before you start getting into creative growth strategies. And that has resulted in NEE being a little bit of a higher valuation in comparison to other stocks in the sector. You're talking about a stock that has a P ratio of 34, which is really high for utilities. The utility space itself has an average P ratio of 25. Its Schiller P ratio is 29. You're talking about a stock with a 34 P ratio that is on the upper end of the entire utility space. It also, from a PEG ratio perspective, 4.36, price to book 3.95. I think you got a little concern, quite frankly, with NEE from a fundamental perspective and a valuation perspective. And it obviously pays the least amount of dividend here as well. AEP to me is honestly both the buy and the hold for me anyways. And the reason I say that is because you're talking about a stock that is utility based. You're talking about a stock that has the highest dividend in this space. You're talking about a stock that has one of the longest payout ratios in this space as well. But you're also talking about a stock that from a fundamental perspective has a 19 PE ratio against the sector of 25. It has a forward P ratio at 17. Its PEG ratio is the best at 3.08. That is overvalued, but in comparison to the 4 that I'm seeing on NEE, it is under its counterparts here. But you're also talking about a stock that is technically, I feel, fairly decent as well. And so when I'm looking at this from a technical perspective, fundamentally, I do think AEP stands out, both from a liquidity perspective, what you can do with covered calls, protective puts when you need. From a valuation perspective, I think AEP stands out against the two counterparts. But technically here as well, when you're looking at, and I know we like to live on weekly charts in utilities, but I got a little concerned about LNT from a short-term technical perspective. I'm looking at a little, not AEP, LNT. I'm looking at a little bit of a double top, violation of support, fighting up against downward moving averages. Whereas when I'm looking at technically on AEP, I see more of a rounding bottom. I see a potential trigger on AEP as it gets above its 50-day moving average. I like the double bottom at 82. I like the continuation trigger above 86. When you look at NEE, I think you can map out a weaker case technically than you can on AEP, but I still think you can map out a fairly decent resistance level that you could trigger above. So I got AEP as the buy and the hold. I think AEP stands out, at least for me. AEP stands out for me, but NEE would be next. LNT would be eliminated due to liquidity issues.
All right. Now, Greg, from your side of it, what would you have done?
Well, there's a few things that I look at that give me cause for concern when I look at these different metrics. I'm not a big fan of not having positive free cash flow. Now, I know there are valid reasons for that, but the reality is if something goes wrong with AEP, it's an electricity producer. They're going to have some infrastructure concerns going forward, and it's always nice to have a couple of shekels in the bank to cover off those kinds of costs, right? Otherwise, you've got to download that to the consumer. Now, having said that, and I'm probably talking out of both sides of my mouth here, having said that, they've navigated this stuff since 1909, right?
Exactly.
Over 100 years. So they've got a good track record of doing that. So that gives me a little less concern. Normally, that would be, very close to a deal breaker for me. But because they've navigated it through so many different things, and they're still going reasonably strong, 3 years of consecutive net increases, that I give them kind of a pass on that one. LNT, you guys hit that spot on. I like the dividend of just under 3%. I like that they've got a bunch of cash in the bank, but the dividend, the covered call, the options, they are a deal breaker. Now, from a stock perspective, you've got lots of shares traded, so this is not a problem to trade this stock. But unfortunately, the options are not liquid, and so that does make a difference. You start thinking, okay, well, maybe I get a 3% dividend, but if I can't get a 1% or even less than 1% per month, I'm giving up double digits for the course of the year. So that's going to be the dump for me as well. The other two here, the only thing that bothers me a little bit about NextEra there. So for me, it's AEP is going to be the buy for me. NextEra is the hold for me, and the reason it's the hold for me is that the zero number of years of net income. So they've got projected here. So they got 10.9% growth this year, and they're projecting 9.2% next year. But that's not really translating into net income. Their net income has actually been falling for the last 3 years. So that's kind of a little bit worrisome. I know you're trading a little bit of growth and all that kind of stuff, but I like the higher dividend of AEP. I like the fact that you can do covered calls on it. NextEra Energy, had they had some decent years of income increasing, they would have probably ended up as my buy. In this case, they are my hold. AEP is my buy, and I'm dumping LNT for the same reasons you guys are. If you can't trade the options, it really limits what you can do with the stock.
Interesting. So basically, we all had the same read on LNT. Great minds think alike. A little bit different read on AEP and NE as to why we got there and how we got there. But I appreciate the thoughts there, guys. It's fun. Good analysis. I actually really enjoyed that one there, Greg. 3 stocks from utilities. I actually thought coming in, I'm like, man, utilities, but man, the conversation was there. And I really enjoyed the fact that we pinpointed the cover call part of it. If you do play utility stocks, cover calls juice those returns, because as nice as a 3.5% return is, even 1% a month, Greg, I mean, by the end of the year, that makes that a very, very different type of investment, right?